There's a lot of fraud in markets. I think we're going to a golden age of fraud right now. I think if you could bring back people from 1928, 1929, they'd blush at what we're doing. And so be it.
Wow.
But eventually the music will stop.
You think the consumer is going to be able to have money to buy things for the next 6 months, rest of the
Well,
year?
it's getting worse. Feels like it's getting worse. I mean, just anecdotally.
I'm pleased to welcome back to the show Father Emmanuel Lemelson. He is a CIO of Lemelson Capital Management and Orthodox priest. Father Emmanuel has been on the show several times in the past. His last appearance 3 months ago made some very important correct calls. We'll revisit those calls for the stocks that he picked, which all outperformed the market during the last 3 months, and we'll get his new picks for the following quarter. Thank you for joining the show once again, Father Emmanuel. Pleasure to have you, and honor to host you once again.
Absolutely, David. The honor is really all mine to join your show. I always say I can't think of a better show to cover financial markets than yours.
Oh, very kind words. Thank you, Father. Let's take a look at the stocks that you picked last time. We'll revisit the rationale for these stocks, get your update on these stocks, and then get some new stocks for us. Big Five Sporting Goods, Nike, Kohl's, Adobe. We aired the interview on the 4th of April, and between the 4th of April to basically yesterday, all five of them except Adobe just outperformed the market, but performed at least as well as the market. So excellent picks there. Let's start by talking about some interesting recent news coming out of the political sphere in the U.S. Elon Musk says he wants to form a new party rivaling Trump's party. Trump called it ridiculous. Yeah. America Party, where here's what to know. There are many recent federal elections filings that reference the Tesla and SpaceX CEO for his companies. Musk himself has even gone on a social media platform batting down at least one filing as fake. The possible new party marks another development in the rift between Musk and President Donald Trump. Before we get into the particulars of this party itself, this America Party, MSNBC is calling it half-baked and has no legs to run, but that's an opinion. I'll get your opinion. Why do you think he's doing this?
Well, it's a really good question. You know, David, we started to ask questions about his political ambitions last year. We published a podcast in June of 2024. I think it was our episode, I want to say 14, where we said, look, this is really a government man. And I think you got to be a little bit careful taking your lead from, mainstream media headlines. Actually, I'd rather get news from you, frankly. But the mainstream media, they're putting out there what they want to put out there. And, the so-called rift between Trump and Musk, I'm not convinced it's what it's really going on. It's what they want us to see. I think whether or not this turns into something that's positive for our country, you have to understand the ideological underpinnings and look at who his advisors are. You've got this guy, Kenneth Yarvin, a complete nut job, in my opinion, who's advising Musk. Their ideas about a dark enlightenment, and of course, Musk is pretty well known at this point for his ideas about accelerationism. This is neo-Carmelism. It's sort of idea that a monarchism should exist. Not that monarchy is bad in all instances, but democracy, as we know it, has certain safeguards in place. It's also not a perfect form of governance. And I believe that Musk very much so is interested in creating what he'll coin it a CEO type government that has total authority. It sort of disregards the desires of the masses of the people. But really, when you talk about a CEO, a sort of Silicon Valley-like monarch coming to lead the country, that's really a bit of a euphemism for authoritarianism, in my opinion. And I don't think Musk is a stable man. I've never believed he's stable. I've had a lot to say about it. We recently published a Substack article talking about just how prescient our podcast episodes last summer were. And of course, in December, we said that we believe that this sort of thing would happen. He ultimately had political ambitions. But whether or not you want to know if this guy should be leading the country politically, don't conflate that with the so-called success of Tesla's stock price. Two totally different things. And you've got to look at the ideological underpinnings of this man and what's really driving him. And it's a pretty dark area to look into.
What are the ideological underpinnings?
Well, yeah, they have this sort of neo-Carmelism, or this idea of monarchism, dark enlightenment, this idea that you have to destroy all the existing structures. Think of it as, move fast and break things in Silicon Valley on steroids. So let's destroy the government. Let's destroy all these institutions, which again, they're not perfect. Our democratic institutions are not, but there's a gigantic bureaucracy. It's inefficient. It wastes money. There is such thing as an administrative state. Those things should go away, but you got to be a little bit careful if people take a seed of truth and they use it to go too far. And just like it's okay to blow up rockets and to have a pretty high fatality rate, not pretty high, the highest fatality rate in Tesla's, this idea that we're going to accelerate into the future, that we're going to sort of create a new God. Like you might say, why is a priest on a show about securities and about capital markets? Well, look around you, religion's everywhere. There are religious instincts driving this man we're talking about right now. I was a pretty prominent figure in capital markets. These ideas that somehow he's going to create a new God out of Memphis, Tennessee, out of his server farms and with his AI, very, very dangerous stuff, if you ask me. Incredibly dangerous. And again, we recently put out a Substack article, sort of tying our previous podcast episodes about this issue together. But look into Kenneth Yarvin. Look at what this guy really stands for. Why is he advising Musk on this America First political party? And are Trump and Musk really in opposition, or is this political theater that's being put out there as a sort of diversion from major, major changes that are going to happen in our country?
Okay, so he actually floated this idea on Independence Day. He ran a poll on X. Yeah. Independence Day is a perfect time to ask if you want independence from the two-party system. Should we create the America Party? 65% voted yes. That's 1.2 million votes. And then he retweeted that just a couple days ago. By a factor of 2-1, you want a new political party, and you shall have it. When it comes to bank, I wonder if he would do this if it was a 2-1 the other way. But anyway, when it comes to bankrupting our country with waste and graft, we live in a one-party system, not a democracy. Today, the American Party is formed to give you back your freedom. I think what he's implying is that this party is not going to embark on wasting and will instead be thrifting. I don't know how he intends to do that with a new party, but anyway, I'll let you comment on that. Whether or not, first of all, that's a true statement that both parties have been wasting Americans' money.
Well, yeah, our government's huge and inefficient, but I mean, he's the poster child for government largesse, right? I mean, he wouldn't be where he's at, but for massive amounts of taxpayer subsidies going directly into his pocket and to beefing up his stock price, which is indefensible. But I agree that there isn't really two parties. There's really a uniparty. The question is, he's selling freedom under the guise of efficiency, right? There's going to be Doge. We're going to cut all this bureaucracy. We're going to cut all these costs. Are you sure? Are you really going to get greater freedom? I don't think so. Because if you look at what he's doing with his Grok AI and XAI, I don't think that's leading to greater human freedom at all. That's not going to set you free. That's going to stifle your freedom as a person. It's already doing that. It's controlling speech. And look how carefully they monitor that. Look at the headlines around Grok AI and Grok recently with these unfortunate anti-Semitic comments. So we've got to put guardrails in place. What does guardrails mean? Isn't that an Orwellian type of newspeak? As unpalatable and as ugly and as dark as some of that speech is, it still has to be free. It has to be allowed, even if it's abhorrent, even if it's terrible. So he'll have great control over human freedom. And again, under the guise of efficiency.
So he still has to get his party on the ballots. Let's just close out the discussion here on this subject. Do you think Musk will be running for president in the next 2.5 years?
I've long thought that's his ambition. Whether or not it actually manifests as a presidency, we'll see. Sometimes the person you see in the front is the person they want you to see, who's the person who frankly can perform the best in front of the cameras. It's really the forces behind the scenes, behind the throne, that really call the shots, and I think that's true of any power structures.
Would you vote for Musk?
No way, not in a million years. Are you kidding me? No, this guy is, in my opinion, he's a cult leader, and there's this rise of cults. America's like a kingdom of the cults. Like, we give rise to all these religious movements. This is a very unhealthy sort of quasi-religious movement behind this man, and it's very dangerous. And
what if he actually somehow, I'm not saying he will, but what if he somehow manages to balance the budget or comes up with a plan, some sort of fiscal plan to bring down the level of deficit, make the government more efficient, reduce spending? Would that sway you in his favor somehow?
Look, I've long believed that one of the greatest things our country produces is business leaders. And, I was the first priest to give a blessing to Donald Trump in 2015 when nobody even took him seriously. He not even won a primary in the fall of 2015. He asked me to give a speech at his rally in Keene, New Hampshire, and I said as much. I said, look, one of the greatest things this country produces is business leaders. I believe in business leaders. I'm not a closet Marxist. I believe in capitalism. It's not a perfect system, but it's the best system we've got. We've got real economic and budgetary problems in our country, there's no question. But we should not be led by fear into electing or putting a person in place, a leader who is as unhinged as Musk. Look, no, we're not trying to elect Mother Teresa, right? I'm not asking for that. I'm not asking for a saint. These are politicians, all right? And is he a shrewd businessman? I don't know. I'm not convinced, because look at how he actually created his wealth. I mean, where did the half dozen regulatory investigations go that just sort of disappeared? So that my criticism isn't that he isn't capable potentially as a business leader, but we have a lot of great business leaders in this country. Trump, for example, is a businessman. He's experienced and he's attacking the problem the best he can. So if he were able to do those things, that would be great, but it still wouldn't be enough for me. No, I wouldn't vote for the guy. I think it's a whack job.
Okay, well, let's take a look at some stocks now, starting with Tesla. Now, Tesla, here's the stock. Let me just pair this with the NASDAQ itself. And as you can see here, over the last, let's just take 6 months. NASDAQ's up 7.5%. Tesla's down 24%. So the stock has roughly mirrored Elon Musk's popularity, which is declining, not increasing. And I wonder if this is more of an events kind of driven share price performance rather than actually accurately reflecting the fundamentals of the company. In other words, is this a buying opportunity for Tesla right now, do you think?
No, I don't think it is. I mean, so we've given rise to meme stocks in the last 5, 6, 7 years, right? Where memes, narratives are driving stocks. Nobody's really, like not nobody, but the majority of investors aren't really sitting down and reading the financials, listening to the conference calls, doing any sort of analysis on whether or not the security backing the share price has any relation to reality. And I think most people who do that would say, well, how do you justify the share price? Now, you could have said early on, well, they have a first mover advantage and they're sort of ahead of the curve on these government subsidies, which, by the way, are going away now with the big, beautiful bill. And of course, not only these companies meme stocks, but they're really politicized stocks. Like you see this also with Donald Trump's stock. And so like this idea that we're going to amend sort of political beliefs or partisan beliefs with a share price, that's like the epitome of speculation. I mean, there you're being forced to go where the crowd is going. You have to ask yourself, when you're the buyer of a share in a company, which is a piece of a company, what is really my security for what I'm paying? So price is what you pay and value is what you get. When you look at the precipitous fall in sales in Europe, when you look at what some of these Chinese EV manufacturers are doing, it is extraordinary. Nothing about Tesla looks great. And I think I might have mentioned on our last show, we say it's an American auto manufacturer, but 51% of their vehicles are manufactured in China. They have access to all that data. I've long said that that Musk is politically agnostic. I think he'll cozy up to any government where he gets what he needs to get, which is greater subsidy and support from the government. And then once you take money from other people, like say the Chinese Communist Party, you're really a Chinese Communist Party man. So this guy works for the CCP, in my opinion. And look at where that's potentially heading. So the company, what's so revolutionary about it? Well, they have data. Well, the Chinese auto manufacturers have a lot of data, the EV makers. Nobody in Europe wants the cars anymore. Nobody in North America apparently wants the cars anymore. Their sales are plummeting. What would you be buying exactly other than a super premium price stock? And it also ran in the EV space, frankly.
Okay.
And I think their cars are ugly.
Cars are ugly.
I think the Cybertruck is ugly. I can't warm up to it. I'm sorry. I guess beauty's in the eye of the beholder. I think the other cars just look kind of, I don't know. Okay, I guess.
I've always felt that Tesla is facing stiff competition from the rest of the sector, but it looks like EV interest overall is kind of waning, and a lot of companies are pulling back their promise to make an EV-only fleet by 2026 or whatever the case may be. But anyway, let's move on to some other stocks. So before we talk about some of the stocks themselves, you've been negative on Tesla on my show a couple times. Tesla didn't perform well. You've called correctly these stocks to go up. They have. So before we actually break down your analysis, just give us an overview of how you pick stocks, what you look for, because you've been right both ways, short and long, on my show at least. So what is your philosophy here? What are the top couple of things, 2 to 3 things that you look for in a stock before deciding whether or not to sell, short, leave it alone?
Yeah, great question. You got to start with the financial statement. So there's qualitative issues and there's quantitative issues. So start with the quantitative. That's usually what I do. Look at the balance sheet. You should go back 15 years. Look at the statement of cash flow. So there's 3 financial statements in the company, right? And most people know this, but I'll just go over it real quickly. So there's the income statement, which is the most fallible. That's why you see like EBITDA and non-EBITDA and adjusted earnings and non-GAAP and all these other things. Then there's the balance sheet, which is less fallible. So it deals with the assets and the liabilities and the shareholder equity. And there's the statement of cash flow. And the statement of cash flow is not fallible at all, barring fraud. So you need to learn to read these 3 statements if you don't know how to already. It doesn't take very long. Maybe you need like half an hour to learn the basics. There's a great little book by Mary Buffett called The Interpretation of Financial Statements. And if you got more sophisticated, you could read Ben Graham's tome, Security Analysis. Once you learn to read the financial, that's the story of the company. And that plays into the qualitative factor, like how good is the management team? Because ultimately, if you've got a great management team, which is good to have, that's going to show up in the financial statements. But if you have to choose between a great business and a great industry, and a rock star CEO, choose the great business and the great industry, because the economics of that business are more important than having a very flamboyant and outspoken and promotional CEO like Musk, for example. Like, imagine if he stopped talking tomorrow, what would happen to the share price of Tesla? He's got to be out there promoting constantly. So highly, highly promotional CEO. The stock's been promoted ad infinitum. So you start by reading the financial statements, then you can get on the conference calls, read the transcripts, and say, what's really going on with this company? And I'll tell you something, if you cannot understand the financial statements, if you cannot understand where the earnings are coming from, and if it looks super premium priced, move on. I think there's 10,000 companies on the stock market. Like, you're going to read about like a dozen or maybe 2 dozen on CNBC headlines on any given month. There are so many more to pick from. So you'll notice a lot of those stocks we talked about on the last show could not be more boring, like Kohl's. I think we got a lot of flack in the comments, actually, right? I mean, Kohl's is probably the most boring company you could think. Big Five, super boring. But look at the returns, and you have to ask yourself, what are you doing this for? You're doing this to get better than average returns. You're not doing it to show that you're smarter than the rest of the world, or because you love Elon Musk, or you think the Cybertruck is great. Investing is best when it's most business-like, and frankly, that means when it's most boring. So, again, starting with the quantitative factors, looking at going back 15 years of earnings, then looking at the qualitative factors, the management team, the business model, is it defensible or is it going to die at some point? Companies have a lifespan. They're like human beings. They're birth, they have adolescence, mature, and eventually they're going to die. There's very few companies that have ever been around for even like 100 years, for example. Coca-Cola is one of them, and IBM for another. But at some stage in their life, they're going to be on the decline. And you obviously want to be able to buy the company, in my opinion, when there's a demonstrable margin of safety. So there's price and there's value. When you're reading the financial statement, you're trying to determine what the value of the share is. If it's trading at 10, you're asking yourself, is 10 fair? Is it expensive? Is it cheap? The only way you can figure that out, and it's not going to come from reading CNBC, is by studying the financial statements and listening to the conference call. That's what the CEO has to say. You get on those calls and ask the executive management team questions as well. You can even go visit them if you'd like. And then you start to get an appraisal of value. And then you can determine, is it higher or lower than the price I'm paying for the shares? Now, in my opinion, the only way to be consistently successful over a long period of time and compound your capital is to consistently pay less than the shares are worth. And the only way you can do that is know what it's really worth.
Father Emmanuel, can you just walk us through maybe your screening process? Surely you have a screening process or criteria in mind when you look for new stocks and new opportunities. How do these stocks even land on your desk in the first place?
Well, there's a lot of volatility going on in the world right now. The volatility has increased substantially in the last 10, 15 years. Probably a lot of it's driven by algorithmic trading, which I think is 75% of share volume in the markets. So what I'll do is I'll just look at where is there a huge drop. Like, for example, we recently began buying a company called Centene. And by the way, this is not investment advice. You got to do your own research. But, when you look at a company like Centene, it drops 40% in a day. You got to ask yourself, like, what went wrong exactly? So there was a price, before the bad news and a price after the bad news, and it wasn't factored in. And markets are very, very skittish, right? Investors could be speculators, I should say, are very skittish, which is the majority of the participants in the market. So they'll overreact. They'll be either fear or greed driving one way or another. And they will go in and look at it and say, well, what's really going on? Like in the case of Centene, we'll look back over 15 years and say, this is incredibly remarkable, consistent earnings. And one of the really remarkable things is the company came out and said, look, we're going to lose like $2.75 a share in earnings. And they had somewhere about mid sevens in earnings. So you can actually just do that math. You can figure out what's the P&E today. Today it's trading like 4.5 P&E. Maybe it's going to be 6 or 7 because the revised guidance lower. They take about 1.8 billion off the revenues. Like, this is math. It's immutable. It doesn't involve emotion. It doesn't involve fear. It doesn't involve greed. It doesn't involve excitement. It doesn't involve needing to be with the crowd. So we'll look for stocks that are getting killed. If we're on the long side, we'll look at just like a screener for a 52-week low, see what's out there. Not that that in and of itself means anything, but really what we're looking for is looking for long histories of consistent free cash flow, consistent owner's earnings, hopefully a dividend, and no loss in, say, the last 5 years or more. And then we start to get a sense of, okay, is this free cash flow that they're throwing off, are these earnings that they're throwing off going to be calculable into the foreseeable future? Now, if we're paying a huge discount for that, like Centene is trading, let's say, roughly at a free cash flow yield of 10, right? 10%. Is it going to be 8 or 7 or it's going to be 11%? It doesn't matter that much if the price is low enough. You can afford to be wrong because there's that proverbial margin of safety. That's the inversion of the speculator's mindset. The speculator is almost the exact opposite thinking. He says, I can pay $11 or $12 a day for a $10 stock because it will be higher tomorrow. It'll be worth 13 or 14. And really, actually, nobody knows that. So the investor has the inversion of that way of thinking and say, I don't know the price tomorrow, but if I can pay a price lower than intrinsic value, which I've calculated on my own, I should be safe even if I'm wrong. So it's predicated on being wrong rather than being right.
Okay. Let's talk about the stocks in more detail now, starting with Big Five Sporting Goods. In our conversation from last time, You describe Big Five as a cigar butt in the Gramian style or sense, a security trading at a substantial discount to tangible book value. Is it still trading at a discount to book value after it's up, 50-something% in the last 3 months?
Well, all the shareholder lawsuits should tell you that it's worth more than that. So it wasn't a perfect trade deal. Look, if you listened to that show and you had bought it at that time, yeah, you would have got a huge return. But their tangible book is much higher than that. So it's a little bit of a fire sale. They were sold to Capitol Hill Partners, I think is the name of the company, and Worldwide Golf, a collaboration between those two companies. Obviously a great deal for those acquirers, but when it was the last time I was on your show, David, it was just a screaming bargain. I mean, there was no risk of bankruptcy, in my opinion. I would have thought it would have sold for more than that, but hey, it's still a fantastic return. So, yeah, but the deal's done. It's been acquired.
What's your outlook on discretionary stocks and clothing companies overall? You think the consumer is going to be able to have money to buy things for the next 6 months, rest of the year?
Well, feels like it's getting worse. I mean, just anecdotally. Inflation is taking on a life of its own. I've been saying that for a long time, 5 years. It won't really matter ultimately what the Fed does, interest rates and so forth, because people, once they get into their mind that the dollar is devaluing, and it becomes a cycle unto itself. But I mean, the reality of the BRICS is real and what they're doing and phasing out the dollar. So you look at these green pieces of paper, at the bank, you can get them and you just ask yourself, how long will it hold its value? And once that enters the collective consciousness of the people, it's going to devalue regardless. So there'll be price pressures. Inflation, of course, is just another term for inflation is another term for devaluation of the currency. So long as that goes on, I think it's going to get harder and harder for consumers. Yes, but things like clothes, they'll need. I mean, if we mentioned Kohl's, for example, I mean that's a discount retailer. So I would imagine people may not shop at Nordstrom's or maybe a premium retailer. Maybe they'll downgrade, but they're going to still need clothes.
Right. Nike isn't just an American company; it's sold globally. So we're not just Nike is not just limited to American consumers' growth. But you wrote here, it's widely followed and frequently priced as a growth company. What is the growth story behind Nike?
Yeah, so in that case, we didn't really even need a growth story, to tell you the truth. It got killed because, especially when the tariffs were announced. But that was resolved fairly quickly with Vietnam, where a lot of shoe wear is manufactured. The fact is, Nike is it's a iconic American brand. I couldn't believe the price it was trading at last time I was on your show. And again, that was before the tariff announcement. So that show was published on April 5th, but we actually talked on April 1st. No, what a screaming bargain. Again, it was really the cheapest it had been in 15 years. And you had to ask yourself, yeah, they had a couple ugly shoes that came out. They probably made some strategic errors. But again, you're buying really discounted cash flow. And that company was really not at any risk of falling out of favor with the population in any meaningful way, in my opinion. And so shoes, again, are disposable. They're not going to last more than 6 months or a year. You're going to replace them. They've got real R&D. They produce a really amazing product. So again, I couldn't believe my eyes looking at the price, saying, why are more people not looking at this and buying it? And so it worked out well. I guess 30% return in the last quarter.
I keep my shoes for years, but maybe I'm an exception. I don't wear my shoes out often enough. Okay, moving on. Kohl's, we talked about this already. Why do you think it's boring? First of all, you use the word boring to describe the stock. What's boring about it?
You've been in a Kohl's lately?
No.
David? Yeah, it's not that exciting.
I mean, I don't. Skincare products, not my forte.
Well, they do skincare. They do a lot of stuff in Kohl's, but it's old school retail. People kind of get a like Sears and Roebuck kind of feel from it, and it is. It's like I could not be more boring. But again, you're not trying to buy like the most exciting story in the world. You're really buying tangible assets. You're buying free cash flow, and you're buying the ugly girl who doesn't want to go out on a date with, I don't want to go on a date with her. That's what it is. In the short term, it's a beauty contest. In the long term, it's a scale. We put a quote in that article actually about Ben Graham saying that. And, no matter how ugly Kohl's is, the fact is it's got this long history of operations. And at that price, it was 24 cents on the dollar from tangible book. I mean, you could say, well, I'll even ride this thing out till it gets acquired or it gets broken up into parts or the assets get sold. I mean, you're going to be covered more or less. Like there's just so little risk at that price. So again, it's a balance sheet play. It was really another cigar, but I don't think Kohl's has a great long future, to tell you the truth. But at that price, the risk was de minimis, in my opinion, and it worked out pretty well. I guess it returned almost 27% in that quarter.
If I were to give you an example of a stock that's trading at maybe above what you would perceive as tangible book value, but there's a lot of hype, there's a lot of media attention, there's a lot of intangible value, let's say intellectual value, not yet baked in or reflected in the cash flow. Tech stocks are good examples of future potential that you're not realizing yet, but there's a lot of hype. they're high growth stocks. How do you feel about that kind of sentiment, that kind of philosophy?
Yeah, no, it's real. David, I don't want to discount that completely. It's just a little bit riskier because you don't know for sure, right? Like in a lot
Mhm.
of those companies you're describing, they don't have very long operating histories. But if you can catch those and be right about it, usually the returns are really super outsized. But if you look at the power of compound interest, you don't need to get super outsized returns. If you were getting, say, 20% per annum, like a Berkshire Hathaway over 5, 10 years, 20 years, even a small amount of money becomes an enormous amount of money. So I think, those are difficult investments to make. You're right about there's price to earnings growth, I think is what you're describing, or the PEG ratio. And that can be very real. You don't have to wait around for a tangible book. Most tech companies could care less about what I'm describing. But how do you know for sure? I mean, it's really difficult to know. So it's just a different area of investing. I think, in my opinion, it's a little bit more difficult. These things are easy, in my opinion. And if you're going to get, say, double-digit returns, and you can do that consistently over a measurable period of time, you should do just fine. If you're willing to get rich slow. The problem occurs when people want to get rich fast, and then they may rush into something and not really have all the knowledge they need to make a good discernment.
Yeah, we talked about number one. This is I think the most important section of your particular piece here. Reflections and investment principles. Number one, intrinsic value matters more than narrative. That's what we're just talking about. Number two, emotions cloud judgment. The market remains driven in the short term by fear and greed, but these are not inputs to valuation. They're distractions from it. I think it ties into number one. So when something goes up 58% in 3 months, and it's more than, I guess, reached your intrinsic fair value that you've assigned, what do you do in that case? Do you upgrade your target? Do you sell? Do you think, whoa, it's gone up a lot more than I thought? Maybe I should reevaluate what the fair value should be, which I guess is the same thing as upgrading. But yeah, what do you do when that kind of do you assign a timeline to when something should be? Yeah,
That's a really good question, David. So you got to keep a couple things. So first of all, in the case of Big Five, which you're
that's
referring
okay.
to, I don't think it actually reached intrinsic value, but let's say it did. Let's say intrinsic value was
Mm-hmm.
$1.50. Unless there's some material change in the outlook of the company that really changes what's going to happen going forward operation. Now, in this case, it was an acquisition, so nothing further really is going to happen. But you really shouldn't sell because your biggest expense line item is tax. So when you think about compound interest over time, you should defer the tax, which is an interest-free loan from the government. You might owe the government, let's say, X percentage of the capital gains, but you don't have to pay it. You don't pay interest on it. So why would you sell it unless there was material change? Now, the other reason why you would sell would be if you simply find a better place to allocate the capital, but you have to take into account the tax effect. So you could say, well, I'm going to sell this. I'm going to take the 30% or 40% hit or whatever, or it might be less if it's long-term capital. You miss 20% plus your state tax and say, well, this is a demonstrably better investment. I'm going to do better than that in this case. And that's a good reason. So those are very rational reasons to sell. Otherwise, if the company continues to produce consistent earnings and consistent free cash flow for its owners, which is not the management team, it's the shareholders, don't sell. It's just hold it unless you have really a much better investment idea and then you can reallocate the capital is the short answer.
Fair enough. Number three is an interesting one. Independent thinking is scarce and valuable. What do you mean by that? I'll just let you explain.
Yeah, my experience, David, it's been that two of the scarcest qualities in human nature are the ability to lead and the ability to think independently. And human beings can be sometimes not unlike herds, of cattle that graze together or fish that school together. This idea of being apart from the crowd can be almost like death, and it will drive a lot of decisions. So if you find, you've got to know yourself. If you find yourself being afraid to be apart from the crowd, like doing something because like no one else seems to be doing it, you got to be kind of honest with yourself because the crowd rarely does things wisely. And this would be an argument against democracy, for example. The idea that the wisdom of crowds is an oxymoron, in my opinion. Crowds are rarely wise. That's why when you go to any park in any city, you never find a statue to a committee or a crowd. It's always like an individual, right? You can have great leaders and thinkers, but crowds, they more often than not, they're irrational. That's where you see the mob effect. When you see looting or something, or these vandalism, people do things in a crowd they'll never do as individuals. So thinking independently is super important. And then, of course, being honest with yourself, what part of your decision is coming from emotion? Are you feeling really greedy? Are you feeling really afraid of something? And, my opinion, David, has always been that the greatest investors are not totally healthy in terms of what we think of a healthy human being because they just don't really feel emotions, which is not human. If you look at a Buffett or something like this, or Ben Graham or a Charlie Munger, there's a part of their brain that's almost broken because they just don't feel anything. And that's not human. And so great investors, they're not really taught. So if you find people who are like, yes, I went to Harvard and I've got all these acronyms after my name, CPA and all these certified securities analysts and all these things, you say, well, but like great investors it's like a personality type. It's the way they're born. And there's a great essay on this topic by Buffett himself called The Super Investors of Graham and Doddsville. I'd encourage anyone to read it. It's a really short read. You can just Google it online. I think Columbia University published it. It takes about 10 minutes. And once you sort of have this moment of clarity, this epiphany that great investors can't be taught. They don't come out of a certain school. Now, if you go to a good school like Columbia or Harvard and you learn the basics, that's icing on the cake, but it is not the cake. The cake is the personality type. And when you find these personality types who are like, yes, buying a dollar bill for 50 cents is way shrewder than paying $1.50 for a dollar bill because you think you know where it's going in price. Once you see, you have that eureka moment and you understand that compound interest is cloaked in the margin of safety, well, you're in an absolute minority. You're almost never going to be doing what the rest of the crowd is doing. And so, but then there's this very normal human instinct. I'm not criticizing people who feel this way. It's actually, I'm calling it normal human instincts, this desire to want to be with the crowd. And unfortunately, that leads to some pretty bad places because you're competing in the markets against people who have way more information than you need or than you have, and very often are willing to do things and compromise in ways that if you're normal, you're not willing to do. So it's extremely asymmetrical, but you will never know that from reading the headlines. The advantage is that the people you're competing against, when there's a trade, you're buying, you're selling, the guy on this side of the table, which you don't know because it's anonymous, institutions, they have just so much more information. It's just so loaded against the deck is so loaded against the retail investor. So you got to know that going into it. And if you're following the crowd because there's headlines and so forth, or you're really impressed by someone's academic credentials, there's really only one question that matters, which is what is your performance over, say, 5 years or 10 years versus a benchmark? That's really what matters. And that should be published right up front for every investment advisor.
But are there things that we can learn or skills that we can acquire to become better investors? I think everyone watching the show right now wants to be or aspires to become better in their investing journey. So if the message here is that if you're born a good investor, well, that's kind of demoralizing for those of us who are not born that way, right?
Yeah, well, a lot of the virtuous character traits that we'd look for in a human being apply. So patience, a desire to work hard. Like, are you working hard at it? Which means reading the financial statements. I really believe very strongly that you have to learn to read financial statements. I mean, the oldest written records we have in history are financial statements from ancient Mesopotamia. They're accounting records. If you don't understand accounting, please take a moment, sit down and learn the basics of accounting. Because if you're not reading the financial statements, you're really not making a wise allocation. You're making a guess, you're making a speculation, or you're following maybe the crowd. But, reading the financial is not that hard. And just like anything, if you do a little bit of it every week, you're going to get good at it. It's going to feel cumbersome at first, but it's going to get easy over time. If you really don't like it, you find it deplorable, and you just want to go back to gambling, I always say go to Las Vegas. You can have a nice meal, see a nice show. Then you lose your money. In the Wall Street is much more ruthless. They're not going to give you a show. You're not going to have a nice dinner. You're just going to lose your money. So, if you're not willing to do the work and be patient, and I know that doesn't sound that exciting, like Robin Hood and like all these exciting stocks, and like, it's like you're in the action. It's kind of like it's like a casino. It's like going to Vegas. But if that really gets you excited, I don't know. Sooner or later, it's going to catch up because the house always wins, and Wall Street is the house. And so, but if you read financial statements and you know exactly what you're buying, and I always tell people, look at it from the lens of real estate. Americans have this idea in their mind, they have to own real estate, it's an investment. I don't really agree with it. I think it's a poor investment, but people know something about a house before they buy it. They analyze it, the neighborhood, the crime rates, how it was built, when it was built, blah, blah, blah. They do an inspection, whatever, they get an appraisal, they do all this homework. And then you ask these people, you're like, so you own Home Depot stock? I have nothing against Home Depot. Like, well, what do you know about it? Well, it's Home Depot. Okay, what about their balance sheet? How have their earnings been in the last year? They look at you with a blank stare, like a deer caught in a headlight. And I point out to them, I say, look, you know what you made on your tax return, how much you paid the government. You know what you paid for your house. You know what your house is worth. You know what it costs to replace it today. And yet you have this other category of investments you're making that you know nothing about. Now, don't you think that's a little weird? And I say it's weird, and it's not through any fault of the retail investors themselves. It's a system that's designed to keep them in the dark, to muddy the waters, and to make sure they're not asking any real critical questions. And so I think once people recognize that, if they want to do better, I would say know what you own, because knowledge is power. And how can you buy something if you don't know what it is? If someone said, David, you should buy this house. Everyone's buying houses in this area. And you'd be like, well, where is it at? And you're like, well, it's in a place. And what color? Well, it's a color. Like you just know a ticker symbol and a price. Like the price doesn't tell you anything unless you know the value. And how do you know the value? You assess the financial statements and the financial showings of the company over time.
Sure.
If you're really interested in this topic, there's a really great book on the psychology of investment by Ben Graham called The Intelligent Investor. I strongly encourage your listeners to read it if they haven't already. If it's overwhelming, it's a big book. Just again, start with Mary Buffett's book on the interpretation of financial statements, which is a great primer to security analysis. The other great seminal work by Benjamin Graham. These are investment thinkers, very, very rational. And if you don't know, Benjamin Graham was the mentor to Warren Buffett. Those books will teach you really 95% of everything you know. There's a wonderful book called Where Are the Customers' Yachts, which you might want to read. I think it was published in the 1950s. And just an absolutely hilarious book about just how insane sometimes Wall Street is. And although the machinations of the market change, we have all these AI-driven algorithm trading, all this, but human nature doesn't really change, David. And to create an ultra wealthy class of individuals like we have today, like an Elon Musk is worth, let's say, 360 billion or something like that, you have to create a class of people who are struggling. We don't really create that much new capital, right? We do when we have a quantitative easing or whatever, or we have these bond purchases from the Fed. But other than that, there's really a lot of transfers. And the people who get very, very wealthy, they need people to feed that wealth. And it's the people who go into it thinking it's a fair game they're playing, and it's really not a fair game. The only way you can level the playing field is to read the financial statements, in my opinion.
Can you give us one or two more stock picks that you like now that you didn't talk about last time on my show?
Yeah, well, I've been backing up the truck on Centene. Don't take that as investment advice. That's just what I'm doing. Maybe I'll be wrong.
What's the ticker again? I'll show it on the screen.
CNC.
Okay.
Again, not a lot of speculation there. So the big, beautiful bill is just going to kill Medicaid for 670 million Americans. God bless those people. We have to pray for them. We've got some real problems in our country. We need to take care of our people. But this was a company that essentially worked through Medicaid and Medicare for reimbursements. Had a huge precipitous fall. I think it was July 1st, fell 40%. That's incredible.
Yeah, what happened?
But if you look at the history of it, so they announced, of course, that they would be impacted by the approval of this bill from Trump, and they'd lose about $1.8 billion in revenue. About $2.75 a share they're going to get wiped off. Now, the good thing about that is that's calculable, right? You can calculate what was the share price before, what was it a year ago, and what's the earnings going to be. Even though they withdrew guidance, you can still calculate it on your own because they told you how much EPS is going to go down. So once you know that, you're talking about a stock that's trading at P/E of 4.5 roughly. But if you take out the $2.75 a share, maybe it's like 6 to 7. Let's call it 7. I mean, a P/E of 7. Wrap your mind around that and look at their history. Look at how consistent their earnings are, and look at the free cash flow yield. Mm-hmm. So if I'm wrong on that, I'll be surprised. I don't think I'll be wrong. We'll check back in a quarter or maybe in a year. We'll see. And then we've been buying this other company, Flower Foods. They make Dave's Killer Bread. I happen to love the product. Also getting killed. I think the ticker is FLO, if you want to look it up. And not nearly as good of a Flower Foods, FLO.
FLO, yes.
Yeah. Again, could not be more boring, right? They make bread like Wonder Bread. Not very popular, but they also make healthier breads like Nature's Own and Dave's Killer Bread. Yeah. Great products. You got to figure no matter what happens to the economy, people are going to buy bread and milk and eggs, right? So this thing is just getting cheaper and cheaper and cheaper. I'm like, wow, I can't believe it. I love the product. Keep buying it. And again, super, super boring. Not the screaming bargain that Centene is. Centene is so beat up. It's like Humana and some of these others, Elevon. And, I just think that whole sector is getting killed.
Underperforms the S&P by this much, which is, I'm looking at Flower Foods, for example. I mean, I don't know anything about the company. I haven't seen the financials yet, but I'm just looking at the stock price. Warning flags are going off my head. I'm thinking, why is this such an underperformer?
Isn't that interesting,
wrong with
David?
the company. Yeah.
Isn't that interesting? Like if it was a house you were going to buy, you'd be like, man, the price keeps getting lower. You'd be getting more excited, right? Isn't that interesting? It becomes less risky as the price go down, right? Not more. It's like most people look at that and their knee-jerk reaction is like, oh my gosh, red flags, like you said. But why would a lower price?
It is less risky. Yeah, it is less risky. I'm just saying, well, if a house is being sold at a 50% discount to the other companies, other houses on the same street, I'm thinking something's wrong with the house. I mean, it's a good bargain, but...
Yeah, so you go and you do an inspection, you hire an appraisal, you inspect the house, you look at it. If there's nothing wrong, and it's just been prejudiced for some reason, then you say, gosh, I'm in the right place at the right time, right? I should buy this thing. And once you know what you're buying, you can act on it. You can't act. Your emotion overcomes you if you don't look at the financial statements. The way you set aside your emotions is by reading the financial statements. And you should be very judicious. Listen to the conference calls, read the transcripts, get on the calls, look around and find out, is there something I'm missing? You should always ask yourself that question, David, which is a really good question to bring up. What am I missing? What do the others know that I don't? That's like the key question. But as the price gets lower, you can afford to be more wrong, right? I mean, if you've looked at the financial, they don't have, egregious amounts of debt, and there's no talk of, a bankruptcy filing or something. You're getting down to tangible assets or below tangible assets, which is not the case in Flower Foods, by the way. But you're looking at a company that has really remarkably good earnings. They had an acquisition that was a little heavy. They probably overpaid for it. In business, David, there's bumps in the road all the time. You want to be buying great companies when there's a bump in the road, not when everything's going well. I mean,
Mm-hmm.
mathematically, that's how you beat the house, is when everyone doesn't want it and it represents less risk. And that delta between the reversion to its fair value, let's say intrinsic value, and what you paid is how you're going to compound your capital
Hmm.
without risk. See, the greatest lie told on Wall Street, David, is that returns are tied to risk. If you buy into that, you're in big trouble because, in fact, the lower the price, the lower the risk. But when you're buying securities from a sell side analyst or an investment advisor or something, like if you don't buy into this idea that risks are tied to return, then they can't really shift accountability from what they're doing to you, the client. And that's
Hmm.
where this emerged, this sort of this idea, this falsity that risk tied to return. Actually, when you take lower risk is when you get higher returns. And the proof of that is simply in understanding the relationship of the price to the intrinsic value. Again, the
Yeah.
problem is most people don't know how to determine intrinsic value. Nobody stops to tell them. Just read the financials, learn accounting. And by the way, if you're a business person and you just invest on the side, learning accounting is going to make you so much of a better businessman because they're complementary. Being a lot of people invest, they're really shrewd business people. They build companies, they've done things that other people can't do. And then when it comes to Wall Street, they wind up doing things that they would never do in their own business. And they may not have learned to read financial statements, but even to determine the health of their own companies and to understand their rate of return on their capital, return on their equity, those sorts of things, what their net earnings are, their gross earnings, their all these important financial metrics. It's like it's like scales falling from your eyes once you learn to read the financial statements. And so I always say to people, if you're a business person and you don't know accounting, this is going to be such a helpful skill set for you, and you will never look at companies the same way again.
Okay, I'll finish on this thought. I read somewhere that investing is more about understanding human psychology than it is understand the markets, macroeconomics, and or the company fundamentals themselves. Do you agree with that statement?
1,000%. I remember before I got ordained a priest, I was telling my bishop, when you go to a seminary, I studied theology for 9 years. You go to a seminary, you have all these courses on psychology because you got to understand people. You got to talk to people. I told my bishop, I've been doing all this work in security analysis. I worked for years for free. For me, it was just academic. I didn't care. I was never driven by money and markets. I just wanted to see if we could be proven right on our ideas. If what this idea that Ben Graham had conveyed and Buffett later on, he expanded on it, this insanity of markets. It's so misguided. I set out to disprove it by publishing all these articles. I published like 200 articles on security analysis. What I told my bishop is I said, I learned more about psychology from working on Wall Street than I ever learned in a seminary. So take it from me. I'm a priest. There's way more. You get an advanced degree in psychology from watching the insanity of markets.
Or get your mind blown because you have no idea what people are thinking and you're going crazy
Yeah.
trying to figure the human psychology out. I just there are practical examples to what we're talking about here. For example, if a company has poor fundamentals, so let's say their free cash flow is deteriorating, let's say their margins are bad, let's say their debt is high, whatever the case may be, you're looking at these financial metrics, it's not looking great, but there's a lot of hype around the stock, there's a lot of interest from a dedicated group of people, fans, if you want to call them that, then, and they push the stock up. Well, are you wrong or are they wrong? Right? I mean, if
Well,
you're shorting the stock on bad fundamentals, then, technically you're wrong, even though I guess there's nothing wrong with your analysis.
yeah, that could happen, David. And
Yeah.
there's a saying that time reveals truth and justice, and there's
Mm.
more financial chicanery taking place on Wall Street than most people will ever imagine. They think there's regulators like FINRA and the SEC. Those guys don't do jack. I'll tell you right now. They actually work for Wall Street. So if you think there's anyone watching, the hen house, no, there's nobody watching it. So, when you really dig in, you start to look at some of these companies that do these things like you're describing, where like they have terrible financial metrics and not going anywhere, but the price stock keeps going up. There is such thing as a pump and dump, and it's everywhere. It happens all the
Mm.
time. So that's what makes shorting such a terrible business. And we're constantly butting up against new highs in markets, and the knee jerk reaction is to short companies like that, and we do short quite a lot. But it's
Yeah.
terrible. It's a terrible business. I wouldn't recommend shorting to anybody, especially in an environment where culturally we've basically killed all the short sellers. They don't have a voice anymore. We just want the good times to roll all the time. And, that's really sad because the short sellers usually are doing the best research. They've got the most intelligent voices, in my opinion. They're the ones who are really pointing out what's wrong in a market or in an industry or in a specific company because they've got the most to lose. And remember, as a short seller, you can lose everything because it's infinite, your losses, right? There's no cap.
Right.
If you're long, you can only go to zero. You can only lose 100%, but you can lose 200%, 500%, 1,000% short. You can lose anything. So it's a terrible business, but there's a lot of fraud in markets. I think we're going to a golden age of fraud right now. I think if you could bring back people from 1928, 1929, they'd blush at what we're doing. And so be it.
Wow.
But eventually the music will stop.
Well, let's hopefully avoid this company's engagement in fraud. So that's where you're here to help us. Where can we learn from you, study your work?
Well, I really appreciate that, David. We recently started a Substack. You can look it up at Lemelson. We have our podcast. We've done a number of episodes on markets. It's on YouTube. It's at Lemelson. It's a very visual podcast, but you can find us anywhere. We don't have a huge following on YouTube yet, but we've got a pretty substantial following on other platforms. But if you do sign up for for any of the podcasts or the Substack, you're probably going to get a whole lot of religion as well. So you got to know that going into it if you sign up for it. That's just the deal. But we do talk a lot about our investments. So it's also lemelsoncapital.com, our website where you can sign up for our newsletter. We have a history page where you can go on the About Us page, read about our history of taking on public companies, which we've taken down a number of them, names you'd know as well. And we've had some pretty long, protracted fights with the U.S. government and regulators over, fraud that we've uncovered in the pharmaceutical space. So fascinating story if you're interested in reading it. It starts with something as boring as accounting, but where it ends can be pretty darn colorful. So I would encourage everyone to follow those stories and read about them because, as they say, a wise man learns from his mistakes, but a really wise man learns from the other guy's mistakes.
Let's learn from the other guy's mistakes through your Substack. We'll put the links down below, and we'll put the links to your other work as well. Thank you very much, Father Emmanuel. We'll speak again soon.
Yeah.
And congrats on your calls.
Yeah, thank you, David. You're doing just such an amazing job. It's really a privilege to join you, and I hope we can do it again sometime.
Thank you, for sure. We'll speak again next quarter, see how your calls for this quarter pan out. Thank you for following the work. Thank you for watching. Don't forget to like and subscribe and follow Father Emmanuel, and the links down below.